Gold, the thing I've gotten wrong over the last couple of years is, and I recognized it finally this year, was that the central bank demand and tether demand too is underpinning price. And you can see it in the chart ever since it broke out, almost 2 years ago. It goes up in regular patterns of 20% rally, 2 to 4 month price consolidation. Everybody gets used to new price, 20% rally, it's gone on this, broken out now 4 times and done that. The next time it does this, and it's going to happen in the first quarter, 20% will take you to about 5,200. And, I was saying this all summer long. I said, well, 20% from 3,500 is going to take us to 4,200. And people are like, oh, it's not going to 4,000. Are you crazy? We did. And now we're kind of used to it. And so 5,000 plus is next. Silver, I mentioned that, and I hadn't really thought of this before 5 minutes ago, but where gold took 18 months, sorry, my nose is a little itchy, where gold took 18 months to double after it broke out to new all-time highs in March of 2024. A lot of times we'll see silver move 2x to gold, up and down.
Craig Hemke, a longtime precious metals analyst, highlights a repeating structural pattern now defining gold and potentially silver. Gold prices have been steadily underpinned by central bank demand and tethered liquidity, a factor Hemke admits he underestimated in prior years. Since breaking out nearly 2 years ago, gold has followed a consistent rhythm. Roughly 20% rallies followed by multi-month consolidations as markets acclimate to higher price levels. This cycle has already repeated several times. If the pattern continues into the first quarter, another 20% move could push gold toward the $5,200 level. Hemke also notes that historically, silver often amplifies gold's moves, frequently rising at twice the pace during major upcycles, suggesting silver could accelerate if gold advances again. Now, we present the clips from Craig Hemke's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Gold, the thing I've gotten wrong over the last couple of years is, and I recognized it finally this year, was that the central bank demand and tether demand too is underpinning price. And you can see it in the chart ever since it broke out, almost 2 years ago. It goes up in regular patterns of 20% rally, 2 to 4 month price consolidation. Everybody gets used to new price, 20% rally, it's gone on this, broken out now 4 times and done that. The next time it does this, and it's going to happen in the first quarter, 20% will take you to about 5,200. And, I was saying this all summer long. I said, well, 20% from 3,500 is going to take us to 4,200. And people are like, oh, it's not going to 4,000. Are you crazy? We did. And now we're kind of used to it. And so 5,000 plus is next. Silver, I mentioned that, and I hadn't really thought of this before 5 minutes ago, but where gold took 18 months, sorry, my nose is a little itchy, where gold took 18 months to double after it broke out to new all-time highs in March of 2024. A lot of times we'll see silver move 2x to gold, up and down. All right, so maybe it takes silver only 9 months to double, half the time. It got there in October is when it broke out. So what's 9 months from October? July? Yeah. August? Okay. That'll work. Now, what's going to drive this? Now, and what's I think the risk too is that some of next year's gains, maybe, like I said, are maybe being pulled forward into this year. And what do I mean by that? The signs have been there all year long of where this is headed, whether it was, the Secretary of the Treasury, Bessent, in Trump's office on February 3rd, talking about monetizing the asset side of the balance sheet. Remember that? And then he quickly tried to walk that back. And then all of a sudden, as you mentioned earlier, this gold starts flowing across into the U.S. and, StoneX said it was 2,000 tons. So you got that. You've got other underlying things like Trump's Bitcoin Reserve Act, where written in the bill, in the actual bill, the House and Senate versions, is the revaluation that the U.S. holds the gold on their balance sheet from 42.22 officially up to whatever price they pick. And when they do that, the Treasury then can just hand out, the Fed can hand out, say, $2 trillion to the Treasury Department to then, and they'll say that that's deficit neutral because they just marked up the asset side. And then they can take that $2 trillion and buy their Bitcoin and build this national sovereign wealth fund. All these signs have been there all year long, right? Further, we're all wondering, oh, wow, how hawkish is Powell and all this stuff and these dissenters and all this crap. Powell's gone, and Trump is going to put in a yes man, whether it's Hassett or Warsh or somebody, and he's going to cut rates by maybe a couple hundred basis points. Bessent has discussed the melding of the operations of Fed and Treasury together to work hand in glove. We've already got Powell announced last week what is undeniably QE, it's interest rate control. They're trying to add $40 billion a month in liquidity on the short end by buying T-bills until he's gone 1st of May. Well, what's the biggest concern then if you're going to cut short rates is what happens to long rates. And eventually, when you're melding the Fed and Treasury together, they're going to yield curve control the long end too. First, just through jawboning, and then eventually, if they have to, actual QE. That institutes sharply negative real interest rates. And all of this stuff is, if you're not told directly, it's pretty easy, at least as I sit here every day, to connect all those dots all year long. And that's why gold keeps going up. That's why silver went to 48 and then didn't go back to 28. It's now 68. All of this is coming next year.
Craig Hemke explains that the biggest shift in gold over the past 2 years has been the steady structural support from central bank demand and tethered liquidity, a factor even seasoned analysts initially underestimated. Since breaking out to new highs, gold has followed a disciplined pattern of roughly 20% rallies, followed by multi-month consolidations, resetting investor expectations at each higher level. After repeating this cycle multiple times, Hemke argues the next 20% move, likely in the first quarter, points toward $5,200 gold. He adds that silver often amplifies gold's moves, historically rising at roughly twice the pace, suggesting its breakout in late 2024 could accelerate much faster than gold's earlier advance. Policy signals reinforce the trend: gold flowing into the U.S., balance sheet revaluation discussions, rate cuts, liquidity injections, and emerging yield curve control. Together, these forces explain why gold and silver remain in a powerful, ongoing bull cycle heading into next year. Let's get back to the interview.
Traditionally, if the yield curve inverts from 2 years to 10 years, where the 2 years a higher yield than the 10, that's a sign that recession is coming. It's when it uninverts, which is what happened late last year, that then the recession has begun. Well, here we are. I mean, they're still printing numbers that show growth, but the employment situation isn't good. In a sense, recessions can be talked into existence. And what I mean by that, is if enough people start thinking that we're going into recession, then they start curtailing their spending. They start doing this. And, like I said, you kind of talk it into existence. And that just hasn't happened yet. I do think the economic assumptions are a little too rosy. I also think the interest pay or the income payments, the income tax payments and receipts that the U.S. government is counting on and trying to manage the deficit, I think that's too rosy. The spending just continues unabated. And so I don't know. Maybe the economy just continues to bump along at a stated 1 or 2% like the Fed says, but that does not change the problem of the underlying math. And that's what this side has been about for 15 years. So the math is the math. And in a debt-based monetary system, you just got to continue to devalue and you got to continue to print. And eventually it takes more, you're just servicing the existing debt, which over the last 12 months on a running 12-month total is now $1.25 trillion. Just simply servicing the existing debt becomes one of, if not the largest line item for the federal budget. So they're going to have to try to run it hot. They're going to have to try to keep the economy going just to generate growth and generate tax receipts. If and when that eventually slows, it just exacerbates the problem even wider because revenues fall to the government and, costs just keep going up and that deficit gets worse and then that continues to compound. So, like I said, I've been expecting a recession. It hasn't happened yet. I think the way they're going to try to run it so hot next year probably won't happen next year either. And in the end, Charlotte, this is good for not just gold and silver. We're kind of in that crack up boom phase that the Austrian economists have always talked about, where they're just printing so much cash that it has to go anywhere. I mean, every time the stock market goes down 3%, they're like, oh, here comes the big crash. And then it just goes into another all-time high. And I don't mean to be whistling past a graveyard, but there's a reason why everything just keeps going up because they just keep printing cash, not in the US, but everywhere. And all of that just flows down to all these different investment assets, and gold and silver and the mining shares benefit as part of that. I think gold's going to keep going up and silver goes at 2x that. And if it really stresses the system, and I mean, there are guys that for whom I have great respect, like Michael Oliver, who got started at E.F. Hutton, when I was like 10 years old. And he thinks silver's going to 200. So that would be okay. So there's an easy one. Let's think outside the box. I'm going to continue. Let's go with the silver mining shares. If you, and again, whether you can buy an ETF, the easiest thing for people, is just buy the SIL or something like that. Because if we're right, there's just not very many of them. I mean, how many primary silver miners are in the world? 8. I mean, they're publicly traded. They're not very many. Most of the silver production comes as a byproduct, of base metals, zinc and lead and stuff like that, copper, even gold. And so there's just not that many investment opportunities. Charlotte, there's the market cap of the big 5 US stocks is like $20 trillion. What's the market cap of the leading 8 silver producers? I don't even know. 20 billion? Is it even that much? Yeah. So if you just peel off a little tiny fraction of the money that's out there, chasing the momentum in these big cap stocks, you peel off a basis point, that's 200 billion.
Craig Hemke argues that today's economic signals point less to a clean recession and more to a debt-driven crack-up boom. While yield curve inversion traditionally signals recession, Hemke notes it's the subsequent uninversion, seen last year, that often marks its arrival. Despite official growth figures, employment weakness and overly optimistic revenue assumptions expose flawed economic math. Policymakers are forced to keep the economy running hot through money creation. As liquidity continues to flood global markets, assets rise not from strength but from excess currency. This environment, Hemke explains, structurally benefits gold, silver, and mining shares as monetary trust erodes. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.